Imagine if you could look at a company's balance sheet and quickly be able to tell if a company was a financial house of cards. Believe it or not, but you can do just that in a few seconds once you learn how to spot red flags. In this video, I'll explain the 4 biggest balance sheet red flags, what they mean, and how to spot them quickly. Hi, my name is Brian Feraldi. I'm a financial educator who's been analyzing and investing in individual businesses for more than 20 years. Balance sheet red flag number 1 is when a company's balance sheet is upside down. What I mean by that is the company has far more debt and liabilities than it does cash. Figure this out. You look at the company's cash and cash equivalents balance and compare this to the company's short and long-term debt. As a general rule, you want to find companies that have more cash than they do debt. So here's an example of a company's balance sheet, and we would look right at the company's cash and cash equivalents, in this case $12.4 billion, and we would compare that number to the company's debt, both short and long-term, in this case about $41 billion. So this is an example of a company that has far more debt than it does cash, which is generally speaking not a good thing. Now you can find these numbers easily in a site like FinChat. For example, I'm going to show you how to do this using Comcast as an example. We'd click this right here to take a look at the company's cash and cash equivalents, and then we would go over to the liabilities and we'd pull up the company's long-term debt and current portion of long-term debt. If we click these numbers to make the numbers go together, then we see that this company has only about $6 billion in total cash and cash equivalents, but more than $98 billion in total debt. This is a balance sheet that is completely upside down, and it's clear that Comcast has financed itself almost entirely with debt. Now that's fine so long as the company has the revenue to continue to pay its interest expense, but from a balance sheet perspective, this would strike me as a red flag. That brings us to balance sheet red flag number 2, which is when a company has excessive amount of intangible assets on its balance sheet. That means that a company's balance sheet is very illiquid, and if the company needed to access its assets to pay a surprise bill, it would struggle to do so. Now the formula to figure this out is to look at the company's total amount of intangible assets and compare that number to the company's total assets. As a general rule, you want to see that a company's intangible assets make up less than 50% of the company's total assets. So in this company's balance sheet, we would take a look at the company's intangible assets, which are trademarks, goodwill, and other intangible assets. We would put that number at about $32 billion, and we would compare that to the company's total assets of $97 billion. In this case, the company's intangible assets is only about 30% or so of total assets, which is an acceptable number. Let's see this number using Verizon's balance sheet on FinChat. If we scroll down and go to the balance sheet and add terms like goodwill, other intangibles, and we compare that to the company's total assets, we will see that Verizon's total assets are about $379 billion, and just about half of those are made up of other intangible assets and goodwill. That means that Verizon's balance sheet is fairly illiquid given how much of its total asset base is in these intangible assets. When you see a company with this level of asset concentration in its intangibles, that is certainly a red flag. That brings us to balance sheet red flag number 3, when a company has a goodwill write-down. Now, goodwill is the premium that a company paid to make an acquisition in the past. When a company takes a goodwill write-down, that's with management team being forced to admit that it overpaid for an acquisition and the value of that acquisition has been permanently impaired. Now, to figure this out, we simply compare a company's goodwill value from one year to the next. So in this case, this company's goodwill value fell by about $400 million. That's obviously not great, but when compared to this company's total asset value, that's not devastating. However, if you see a company take a massive goodwill write-down, especially compared to its total assets, that is a huge red flag for investors. We saw this happen with Teladoc Health a couple of years ago. If we scroll down to the company's balance sheet, click on assets, and then click on goodwill, you see that this company at one point had more than $14 billion in goodwill on its balance sheet due to a massive acquisition that it made in 2020. And just 2 years later, more than $13 billion of that goodwill was written off, which was management team admitting that it dramatically overpaid to make that acquisition. Now, this particular acquisition really blew a hole in the company's balance sheet. So if you see a big goodwill write-down, that is a huge red flag for investors. That brings us to balance sheet red flag number 4, when a company's balance sheet is rapidly deteriorating, aka all of the company's key metrics are trending rapidly in the wrong direction. So the company's cash balance is declining, the company's receivable and inventory balances are rapidly increasing, and the company's debt balance is going up. When you see a company's balance sheet rapidly deteriorating, that is a huge red flag for investors. So the key metrics to watch here are things like cash and cash equivalents, the company's accounts receivable balance, the company's inventory balance, and of course all of the company's debt balances. As a general statement, we want the company's cash balance to go up, receivables to stay flat, inventories to stay flat, and for the company's debts to go down over time. When you see the opposite happen, that's a red flag. Now, an example of a company with a rapidly deteriorating balance sheet today is Rivian Automotive, ticker symbol RIVN. If we pull up the company's cash and cash equivalents, receivables, inventory, and total debt. If you track these figures over time, we see that in 2021, when the company came public, it had $18 billion in cash and just a small amount of long-term debt, receivables, and inventory. As the company has ramped up, we see that the company's cash balance has fallen dramatically. Meanwhile, its long-term debt balance and inventories and accounts receivable have all increased. So this is very clearly a company's balance sheet that is in distress, and Rivian needs to do something to fix this situation. Now, it's important to note that not all of these balance sheet red flags means that you shouldn't invest in a company. However, if you find a company with any of these balance sheet red flags being tripped, it's your job as the investor to investigate further. Now, it should be clear that if you're an investor, it's absolutely critical that you learn how to find, read, and analyze financial statements. But financial statements like the balance sheet can be incredibly confusing because they're not standardized, and there's so many different terms that companies can use when they're making their own financial statements. And this goes for all three financial statements, including the balance sheet, income statement, and cash flow statement. To make this easier for you to understand, I created a free ebook called Financial Statement School that explains all the terms on the three financial statements in plain English. If you want a free copy, simply click the link in the video description or visit longtermmindset.co/FSS ebook. Thanks for watching. If you enjoyed this video, give it the thumbs up. And if you want to keep learning, I highly recommend you watch this video next.